Hi there, and good afternoon. Before I start, I just want to say that all my presentations owe a lot of the valuable insights and often tricky data collection efforts made by others, and I'd like to acknowledge insights from Brad Setzer at the Council for Foreign Relations, Robin Brooks of the Brookings Institution, Alfonso Pecciatello and Brent Donnelly of the Macro Trading Floor, and Capital Flows, and others. And the reason why I mention these is because I'd like to talk to you about a synthesis of ideas that I consider valuable, and because some of you may want to follow up and actually look at some of the things they say, not just about gold, because they don't often talk directly about gold, they talk about other things that are really incredibly interesting. And importantly, gold prices, of course, don't emerge in some kind of vacuum. The broad macro influences on gold are incredibly important to try and understand. Some of you may have come to a presentation I made in August. In that presentation, I made a bigger point about the impact of post-inauguration Trump world translating into a general economic shock to the US economy and to the dollar. And this presentation, I'm going to focus more on the macro environment, what that suggests about asset markets and the behavior of the gold price. Here's a slide of the estimate, a pretty good estimate actually, of the real value of gold compared with the spot value of gold. And you can see they've become massively detached despite spending a great deal of time actually working together. And they'd work together, if I extend the x-axis far to the left, they work together quite a lot, but they've obviously become hugely detached since about 2022. So what macro world do we live in that actually leads to this sort of separation? And once again, looking at the world through an American lens, you know, the US economy looks pretty good. US earnings per share expected to grow about 11% in Q3. Labor market doesn't look so good, but it isn't really contractionary either. And analysis by the Federal Reserve Bank of St. Louis shows that payroll declines in expansionary phases of the economy are actually pretty common. And in fact, what is uncommon is how few months in which payrolls declined in the current period of US economic growth. In other words, that period post-COVID. Asset prices are high, equities, crypto, commodities are all high, corporate bond spreads are pretty low, even trade-weighted dollar is actually high by historical standards. But bonds are cheaper, they're lower in the long end for reasons we'll discuss. Now, if you accept that the US economy is broadly resilient, and from here, despite various threats, it seems to be, then what about macroeconomic policy settings? Well, the macro reality is that both fiscal and monetary policy is pro-cyclical. That means it's expansionary. And that would explain how the current cycle favors almost all assets. You know, an expansionary liquidity cycle kind of floats all boats, apart from longer-dated bonds. And you can see here, US government net federal outlays are rising and net doing pretty well. So we're not in a contractionary fiscal world. And then looking at monetary policy, there's another way of looking at pro-cyclical monetary policy is what the policy rate should be at the moment, what advice says it should be. And the rule I'm going to use here, because it's a pretty objective rule, is the Taylor rule. It's created by economist John Taylor to enable a very objective means of deciding policy rates, and it was a significant contributor to the credibility of central bank independence and reducing the volatility of inflation. The Fed's policy rate looks pretty soft with the red line here when you look at it this way. And that's true of a lot of other developed world central banks too. The Fed is not alone here. So this is a post-COVID picture. So has the Fed ever really obeyed the Taylor rule? Well, you can see it actually has very closly for quite a long time. But also the first clear signs of not obeying the Taylor rule emerged just post the dot-com crash of 2000. And then it became really entrenched. They didn't follow the Taylor rule. Bouts of quantitative easing dealt with those occasions in the GFC and COVID when policy rate hit the lower bound. You can see there's a little missing text box there, but it just means there's a lot of QE there. So what about adding gold to that picture? Well, it's not necessarily a hugely strong relationship, but if you look at the period where the Taylor rule was significantly above the policy rate, you can see that gold is beginning to enter a really strong secular bull market. Arguably, the benefit of paying attention to the Taylor rule and the deflationary impulse of China joining the WTO has led to a pretty well-anchored inflation expectations and less aggressive Fed reaction. So, to summarize, it looks we live in a world that's broadly accommodative in both fiscal sense and a monetary sense, and that's helping pump a lot of assets higher, with the addition of a positive narrative around artificial intelligence, AI, and tech overall pushing equities higher. On the other hand, concerns about debt issuance and inflation are helping gold. What challenges that outlook is that tariffs, which are a tax by any other name, will start to drag on the economy. So far, it's the US corporate sector that shouldered most of that burden, but I expect that shift to the US consumer. So whether the corporate sector experiences margin compression, which it is, which should feed into earnings, or whether consumers experience higher prices, dragging on consumption, US equities will likely face a headwind which favors gold as an alternative asset class. Also, US government shutdown will remove significant spend from the economy. The economic impact is estimated to be about 80 basis points this quarter, or an annualized 10 basis points of economic growth for every week the shutdown goes on, according to research by JP Morgan. Now, that will likely smooth the path for the Fed to cut rates. At the moment, they're cutting into a strong economy, but that could make them cut into a weaker economy. There is a big difference between cutting into a relative economic weakness rather than the current picture of cutting against a background of a resilient-seeming US economy. The point here to note is that whilst the current economic picture does look resilient, there are very serious headwinds that can act together. And is that good for gold? Probably yes, because they represent gold in a relatively positive light as a competing asset class. So let's look at the US dollar, because much has been said of the US dollar in connection with the increased demand for gold. Most of those arguments touch on the declining presence of gold in reserves and a comparative oversupply of US dollar-denominated debt, along with a lack of will to rein in debt in the face of demographic pressures and possibly higher military spending. What there is evidence for is the privilege the US enjoyed as a debt issuer in the world's reserve currency has been eroded away. It is now cheaper to buy developed market government debt and convert it into dollars using the swap market than it is to buy US debt. However, that erosion's been a reality for the last decade, and whilst it does give a lot of context to gold's rally over the last 10 years, it doesn't explain the last few months. The basic outlines of the dollar this year are still highly valued. The big decline this year still leaves it highly valued. I think that there are two reasons why the sharp decline happened. One, the Trump administration economic policy shocks certainly helped the dollar lower, despite tariffs actually being dollar positive. Two, there are huge foreign holdings of US assets that are unhedged, because foreign holders have benefited from a massive US portfolio outperformance and a dollar that rose over 20% from the lows in 2019 to the end of last year. It's highly likely that some of the selling pressure on the dollar came from asset managers hedging their exposure to US assets, and a little bit of a net outflow as foreigners disinvested slightly in treasuries in April. They came surging back the following month. Now, just a quick look at major currencies asset manager positioning. You can see that there was a quick run to hedge, but that narrative is now changing and people are turning back to the dollar. Psychologically, the narrative that US exceptionalism was probably broken took hold briefly. The reality is largely unchanged. The conditions for US outperformance and innovation remain largely in place, and there are signs that foreign flows are returning to the dollar. This is actually a side of just how huge net inflows are into the US into holding US assets. It's absolutely vast. Sorry, let me take that back a bit. If you've ever wondered why the US dollar was tracking so powerfully upwards when some observers were yapping on about US federal debt, that chart is actually your answer. So much for the macro drivers ahead. What about the immediate issues we face? Gold is rallying along with substantial rise in long-term yields, which speaks to a weakening confidence in government debt and fiscal policy. However, at this point, rising yields really mean Japanese government bonds and French OATs, as US and sterling long-term yields are turning lower. I'd argue that this is now potentially a stale narrative for gold. What other risks lie ahead? The possibility of central banks selling. Some banks may have to rebalance or choose to rebalance their portfolios. It may not be meaningful in size, but it would have an outsized impact on the official sector narrative, which has done a fantastic amount of heavy lifting for the bullish case of gold. And let's face it, there is less central bank buying this year than there was last year, and yet gold is 50% higher. So to be a little bit challenging about it, if people are saying it's all about central banks, that doesn't really make a lot of sense. Initially, tariffs act as a drag on our economy. That may be compounded by the government shutdown, of course, and that challenges the resilience narrative. An expectation is the US economy runs hot into 2026 as the Fed cuts into an economy that looks decent as of now, spurring greater fears of inflation, emphasized by an FOMC that's possibly captured by Trump-friendly appointees. That is good for gold. Macro observers point to a shrinking US labor force at a time where there may be significant need for labor in AI data centers. AI data centers are tangible things, as are the electricity pylons and the grids needed to power them. Someone has to build those, and a labor shortage will lead to more inflation. That allows both equities and golds to rally if the Fed continues on a dovish path post-Powell. Lastly, the Bank of Japan could decide that interest rates do need to rise to respond to persistent inflation. Letting the yen absorb that shock isn't going to work for much longer. That could cause a significant unwind of the carry trade and a destabilizing shock through FX and rates that, again, should be positive for gold. I've managed not to mention AI at any point in any previous presentation, but it's a key narrative in US equity valuation. So far, fears of an AI bubble are balanced by the fact that although investment in AI is huge, it's largely funded out of operating income, with debt playing a smaller role. When debt plumbs a significant part of the AI growth story, that will be a proper warning. But that warning doesn't have to happen for a significant re-rating, i.e. potential downfall, in the price of AI-related stocks. Gold may suffer initially as cash becomes king, as it did in the aftermath of the Lehman shock. But gold's weak correlation with equities will help underscore its strength as a financial haven. My final observation, very, very unscientifically, is that if you show a chart like this to any trader, they will likely say be very careful indeed, as the recent trend has exploded out of a rising linear channel to something that exposes a power law movement. So to summarize, gold is in a bullish macro setup. That is unchanged. There are significant and viable targets higher. However, it would be fraudulent to stand before you and not point out that the very imminent future does not have to closely resemble the recent past. Thank you very much.